Because economists have completely confused those things, both in monetary policy terms, but also in economic thinking, and because most people still harbour the old-fashioned view that you need savings before you can invest, that we have the mess that we're in today. Now, one of the reasons why we find it difficult to understand the banking system and credit creation is that we leave school without any money and we go and get a job working as an apprentice to a plumber. We work really hard all month, and at the end of the month somebody puts money in our bank. And so for us the logic is you work and then you get money, you get savings. In reality, you would never have got that job if credit hadn't been created in the first instance. It's a really important conceptual misunderstanding, and it isn't something that the public just are guilty of. Economists don't understand this stuff.
Money doesn't come out of economic activity. A lot of people I've come across kind of assume that if you've got businesses and you've got people doing things, that somehow money somehow emerges out of the process of people doing things, making things and growing things and selling things and producing things, that somehow money just emerges. It's not. It's like oil in a car. You have to put it in.
When I see David Cameron talking about how we need an economy not based on debt, but we need an economy based on savings, he just doesn't know what he's saying. It's ridiculous, it's absolutely absurd, and it shows his complete lack of understanding of how our money system actually works. What he's essentially saying is that we need an economy with no money. If everyone was saving, we'd have mass disappearing of money, which is essentially what a bank write-off is. Essentially, is people defaulting on their debt, which essentially is just money disappearing. But if people weren't taking on the debt, then it's just such a joke. It's such a amateur understanding of how our economy works and how the monetary system works and how money is actually created. So I really do get a laugh out of watching what people are actually saying, and they're all just regurgitating what they've learnt off each other, and you just hear the same things, and it just makes me, it really gets on my nerves when I hear people talking about yeah, we need more regulations, we need to regulate the way banks are actually, and the bonus. It's all just one big smokescreen and working on all the symptoms of a greater disease, which is really, you need to look at the money system, the way money is created. And if we don't want any debt, then we're essentially saying we don't want any money and we want a moneyless economy with the exception of the 3% that's created debt-free.
You know, it's a paradox under the current system. If we, as the public, go into further debt, then that's going to put more money into the economy and we're going to have a boom. When you have a boom, it's easier to borrow, so people get into even more debt. And eventually, you know, this cycle continues. It gets easier and easier to get into debt until some people get over-indebted and then, you know, they default. They can't repay their mortgage. That's what happened in, you know, it happened first in subprime America. And then, you know, that just brings through a wave of defaults which will ripple across the entire economy. The banks go insolvent, then we're into a financial crisis, and then the banks stop lending. And you know, they were excessively lending in the boom, and then they stop lending, and then that makes the recession even worse. People lose their jobs, and then they become even more dependent on debt just to survive, basically. You know, we have a system where we have to borrow in order to have an economy. We have to be in debt to the banks. And that guarantees, you know, a massive profit for the banks.
This is the boom-bust cycle.
And I have said before, Mr. Deputy Speaker, no return to boom and bust.
Net bank lending must forever increase.
We're paying interest on every single pound. Even if you think the money belongs to you, somebody somewhere is paying interest on that money.
The banking system has such a huge impact on the world, but only because it supplies our nation's money supply. We have to protect them, we have to subsidize them, we have to allow them to continue, because the disaster of a bank collapse affects us all in a huge way, and anyone that says that we shouldn't have bailed out the banks doesn't quite understand the nature of our monetary system. That's like eliminating a huge chunk of our money But also, bailing out the banks is perpetuating a system which is never going to work anyway. So whatever we do, we're always going to have this cycle until we separate how money is created and the activities of banking. Then the banks can do as they wish. They're a normal business like everyone else.
There's a major democratic issue here as well. I mean, you have these private profit-seeking banks creating up to £200 billion a year and pumping that into the economy wherever they want, basically, wherever it suits them. Whether they're pumping it into these toxic derivatives or putting money into housing bubbles, just making housing more expensive. £200 billion in 2007 of new money coming into the economy, created out of nothing, and where that gets spent determines the shape of our economy, effectively. So if we're going to allow anybody to create new money out of nothing, then we should at least have some democratic control over how that money is used. I mean, would we rather have had that money used for healthcare, to deal with some of the environmental issues, to reduce poverty, or would we rather have it to make houses more expensive so that none of us can afford to live in a house?
You can see it as a subsidy, a special super subsidy to the banks for the right to create money, which should be for the benefit of the public and spent through a democratic process.
There's also another form of money, which is effectively an electronic version of cash. And it's a type of money that the commercial banks use themselves to make payments between each other. The high street banks don't want to be carrying around huge quantities of money because it's dangerous and it's inconvenient and it's expensive. You have to hire security guards for that type of money. So what they do is they pay each other in what is an electronic version of cash, which in the industry is known as central bank reserves. They keep this electronic cash in accounts at the Bank of England. But as a member of the public, you can't access this electronic cash. You can't get an account with the Bank of England. What they do is they effectively sell this central bank money to the banks. And they do this by creating it out of nothing and using this money to pay for bonds, to buy bonds from the high street banks. So the high street bank will come along with a bond which is effectively government debt, and it will give it to the Bank of England, and in return the Bank of England will type some new numbers into the bank's account at the Bank of England. So effectively they're creating central bank reserves out of nothing.
The Bank of England creates central bank reserves by increasing the available credit in the settlement bank's account with the Bank of England. The settlement bank in return posts bonds or sells assets as collateral for the reserves. A total of 46 banks hold central reserve accounts at the Bank of England. Smaller or foreign banks hold accounts with one of these 46 banks to allow them to accept or make payments in pounds sterling. Prior to March 2009, the Bank of England would ask each of the major settlement banks how much reserve currency they needed. The settlement banks would then swap a bond for the reserve currency and agree to repurchase the bond for a specific amount at a specified future date. The settlement banks would then receive interest at base or policy rate for the central bank reserves they held. Since the crisis, settlement bank central reserves have shot up dramatically. When bank customers transfer funds from their account to another person's account, a process called intraday clearing occurs. The amount of central reserve currency Bank A has at the Bank of England is reduced by the corresponding amount that Bank B receives. This is the importance of central reserve currency to banks. Before the credit crisis, if a bank was short of central reserves at the Bank of England to meet its obligations, then the bank would have to loan reserves from other banks with interest.
If you sell something on eBay, you know that that deal's not complete until you get some money put into your account. You know, most people actually want to see the money in their account before they're happy to close on a deal. Now the banks are pretty much the same, but they want to see the money in their account at the Bank of England before they consider a deal complete. So for example, if you're buying a house from somebody who banks with a different bank, then what'll happen after you spent $250,000 on a house is you'll tell your bank to transfer some money to the house seller's bank. And what the bank will do is actually instruct the Bank of England to move $250,000 from their account at the Bank of England to the bank of the house seller. And that money will actually move across between the accounts at the Bank of England. When that money is moved across, then the banks will consider that that payment has been made, you know, it's been settled. They don't really deal in the kind of money that we have in our accounts. They deal in this special money that can only be used at the central bank.
There are millions of people across the country, all transferring money to each other using only a few major banks. These banks can keep a tally on their computer systems, and usually many of the movements cancel each other out at the end of the day. The 5 major banks, RBS, Lloyds, HSBC, Barclays and Santander, hold over 85% of all deposits. As there are a limited number of banks in the system, the central reserve money can only be moved around them in a closed loop.
The money is just circulating through this system over and over again. And if you think about it, a £1 coin could be used to make £1 billion of payments if it was circulated 1 billion times. And that's effectively the system that you have now, is you have a small pool of real money that's just going round and round the system, and it's being used to make a huge quantity of payments on our behalf. Just before the crisis, there was only £20 billion in the accounts at the central bank.
September 2007, thousands of Northern Rock customers queue up to withdraw their cash. The company had been forced to seek emergency funding. It's the first run on a British bank in 140 years.
If they don't have enough of this central bank money, then effectively they can't make payments. And if that happens, then pretty quickly the entire system seizes up. So the Bank of England has the responsibility of making sure there's enough of this money in the system.
The requirements for banks to hold a specific amount of reserves has changed many times since 1947. At that time, banks needed to hold a minimum ratio of 32% of reserves, cash, or treasury bonds to deposits. In 2006, the corridor system was introduced, in which banks could set their own reserve targets each month. The rules changed again in March 2009, when the Bank of England introduced quantitative easing. Quantitative easing, in effect, gives settlement banks the central reserve currency for free. The central reserve currency is what is referred to as the real money in the fractional reserve model. But the fact is, banks can have as much of this as they want, and central reserve currency itself is a form of fiat money, which is backed by nothing. As a consequence, there is no longer a meaningful fractional reserve.
If you look over the history, the last 150 years or so, you start off with the development of a gold standard that really comes to the fore in the 1880s, 1890s, where essentially countries peg themselves to a particular defined value of gold, and then they have an agreement to fix that value, to hold that value, and to trade gold amongst themselves to make sure the balances are all there, and also to try and restrict or expand or contract activity in their own economies to make sure that the balance, that particular fixed price is maintained. That disintegrates after the First World War. I mean, this is where the whole thing breaks apart. Very major dislocation in the international monetary system at that point, not really resolved until you get Bretton Woods agreements at the end of the Second World War, in which everything is pegged to the dollar and the dollar is pegged to the gold. So you're kind of one remove from gold backing or saying that there is a definite, sort of solid commodity money behind the paper money and the credit money that we're all using over here. You're kind of one remove from it.
After Hiroshima, Tokyo wondered when the next atom bomb would fall. They did not wonder long.
In 1944, at Bretton Woods, the US and the UK began to negotiate how to govern the world economy, the world monetary system, and came up with the World Bank and the IMF and a series of other institutions designed to manage the global currency. And there was still a gold standard, but this gold standard was going to be tied to the dollar. All of the world's gold had moved from London to Fort Knox, and all of the world's currencies were tied to the dollar. This system was designed to manage the sorts of imbalances, to avoid credit crunches, or for countries, the credit crunches are known as balance of trades deficits, i.e. when they can't pay their bills and their currency collapses. The currencies were managed, and the system was stable, as long as the Americans played the role of oversight. Now, who knows the great story about how that all came to an end? So the quantity of money that was needed to pay for the Vietnam War, that's exactly what I was trying to get at. Oil shocks was another one. That meant that the Americans were no longer respecting their role or playing their role governing the monetary system. They were inflating the value of their own currency, but ostensibly it was meant to be tied to gold and to every other currency. So what did the French do? The French were a little bit worried that President Nixon wasn't entirely honest. And they were worried that that precisely what we described, that Nixon was printing money when he shouldn't have been, was going on. And they were worried there wasn't enough gold to honor the exchange rate of the French franc. So they sent a gunboat to New York Harbor to ever so politely ask for our gold back, please. Did they get their gold back? Go on, guess. They didn't. And the Bretton Woods system came to an end. And this is the point in which we enter the modern era of the financial system.
Historically, money creation was pegged to a commodity, often gold, but today it is pegged to nothing.
Which means there is nothing backing our money. This piece of paper is just a piece of paper. Where does this leave us? If money is based on nothing, why do we think it has any value? Sorry? Because we can still go and exchange it. What? Well, somebody else was going to shout. Great little Latin fact, the word for credit comes from belief. Correct.